Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at FTAI, or FTAI Aviation Ltd. FTAI Aviation owns and maintains and leases commercial jet engines with a focus on CFM56 engines. Here's the BarChart.com technical opinion rating for FTAI. The bar chart rating is a 100% buy with a strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that FTAI is well above the moving average line, so the monthly trend in FTAI is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since since March. So the daily trend is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. FTAI is below the upper Keltner channel line, so FTAI is inside the buy zone. Since the trend is up, we want to buy a call. FTAI has 10 option chains to choose from, I believe. We're going to use the SEP20 option chain. Right now, the SEP20 options have 54 days to expiration. Here's most of the FTAI option chain for SEP20. FTAI closed at 112.63 on Friday. That means any calls on the list from 60 to 110 are in the money. Let's take a look at the profit potential for purchasing the 115 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 115 call is 740 to 780. We tried to enter at the midpoint, so we'll use 760 as the buy price. Our call option calculator shows the profit potential for this call based on FTAI price changes at option expiration from flat to a 12.5% increase in price. We can see that if the FTAI stock price is flat at 112.63 at option expiration, the 115 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 100 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 100 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the FTAI stock price is up 1%, the 100 call will lose 15.6% of its value. We want that to be break even or better, so the 100 call does not meet our requirements. Let's see if the 85 call will work. The bid-ask spread for the 85 call is 26.20 to 30 even. We tried to enter at the midpoint, so we'll use 28.10 as the buy price. The 85 call works. If the FTAI stock price is up 1%, the 85 call will make a 2.3% or $66 profit. That's better than break even, so the 85 call is the one we'll buy. The call option calculator picture also shows that if the FTAI stock price increases by 2.5%, the 85 call will make an 8.3% or $235 profit. Whoops, should have closed this. If the FTAI stock price increases by 5%, the 85 call will make an 18.4% or $516 profit. If the FTAI stock price increases by 7.5%, The 85 call will make a 28.4% or $798 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the FTAI stock price does not make the expected move up and remains flat at expiration, the 85 call would only lose minus 1.7% or minus $47 compared to the 100% or $760 loss for the 115 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the FTAI SEP20 95 strike call and sell to open the SEP20 105 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 95 call for $20.05 and sell the 105 call for $13.25. $20.05 minus $13.25 equals $680. So the entry price or debit cost for the spread is $680. The call option spread analysis calculator picture shows that the spread will make a 47.1% or $230 profit if the FTAI stock price declines by 5%, remains flat, or increases in price when the options expire. If FTAI is down 7.5% at expiration, the trade will make 35% or $238. Creating the debit spread will allow us to let the $1,325 cash credit to our brokerage account for the sale of the 105 call. As we said on the previous slide, this reduces the cost of entering the spread to $680. Here's a note regarding earnings reports. The next FTAI earnings report is scheduled for October 22nd. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the FTAI SEP20 85 strike call for $28.10. We also reviewed a spread. The spread said to buy to open the FTAI SEP20 95 strike call and sell to open the SEP20 105 strike call at a debit of $680. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.